Okay, Bismillahirrahmanirrahim. Today is lecture number 6, and this is the continuity of IFRS 15 revenue recognition. Okay, today topic is sale and then repurchase agreement under IFRS 15. So we have to study today the sale and the repurchase agreement under IFRS 15. Clear? So here, okay. You know that what does we mean by the sale and repurchase agreements? In simple term, you can say that an entity sell an asset but retain the right to repurchase it in the future. So we call this is the sale and repurchase agreement. Let's say here, this is the entity, okay, and the entity is selling asset, and this entity also retain right to repurchase the same asset at future date. Then we call this sort of arrangement is sale and repurchase arrangement. Now, how you will treat this? What is the accounting treatment? Accounting treatment. So, the accounting treatment is basically depend on the nature of repurchase option, and the second thing is transaction structure. Clear? So if you have this sort of arrangement that entity for selling the asset and retain the right to repurchase the asset at a future date, then the accounting treatment will depend on the nature of the repurchase option and the transaction structure. Now, to determine the accounting treatment, okay. Okay, so the selling asset and return right to repurchase the asset, it means that you are an agreement of sale and repurchase. Okay, now the accounting treatment depend on the nature of the repurchase option and the transaction structure. How you will determine the accounting treatment, so that for to determine the accounting treatment, then you have to understand that whether the seller has the obligation, whether the seller has the right to repurchase it, and you also consider the repurchase price in relation to the original sale price. Okay. Okay, now you have the first one is forward contract. In forward contract, the seller has obligation to repurchase. Okay, so in this case, a seller must mean forward contract repurchase the asset. Then what you will do, you have to not recognize revenue not revenue recognition, and the reason is that control has not transferred to the customer. So when the control is not transferred, then you will not have to recognize the revenue, and this is called forward contract. So what you will do if you have situation like this, then you have two outcomes. Then you have two outcomes. The first one is that you may count that amount is a loan, or you may count it as a lease. So you will check the repurchase price, and the repurchase price means the exercise price. And the repurchase price is greater or equal to the original price, original selling price, then you will count that transaction is a loan. For example, let's say the repurchase price is $1,200, which is equal or more than the original price that is $100. So you will have to record this is a loan, okay, with a $200 of finance cost. Clear? Now, what if the repurchase price is less than the original price? So you will again here you count this is the repurchase price, which means exercise price, and this is less than original selling price. For example, let's say the repurchase price is $800 and the original price is, let's say, $100. Then you will count this as a lease, and you know that lease we are treating under IFRS 16. Hope you guys understand this. Okay. Now this is the scene where you have forward contract. Okay, if this is call option. By call options we means that right to repurchase the asset. So you have to do the same treatment as for call option as we do for forward contract. Clear? Now, if you don't have call option or forward contract, then you will have another option, and that we call, this is the third one, that we call put option. By put option we means that you have obligation to repurchase the asset at customer request. So that sort of this is the repurchase agreement type, that if you have put options, mean the customer can force the seller to repurchase the asset. Okay, so the customer can force seller to repurchase the asset. Then in that case, accounting treatment. Okay guys, I think there's some voice problem. Let me repeat it again. Okay, if you have put option, by put option we means that obligation to repurchase the asset at the request of the customer. Fine. Now customer can force the seller to repurchase the asset, and the accounting treatment depend on purchase prices versus original selling prices. Clear? Okay, I think this some the voice was muted, so I have repeated it again. Clear? Now what you will do, you will consider you definitely you have two scenarios. The first one is, let's say if the repurchase price is greater or equal to the original selling price, then you will have to consider a financing arrangement. Clear? In this case, let's say you have this as your repurchase price, which is equal or better than the original price. So you will have to record loan with $100 of finance cost. Clear? Now, if the repurchase price, the second scenario is if the repurchase price is less than original selling price, then what you will do? Then you will have to treat the transaction as a lease, and you know that we are dealing with lease and under IFRS 16. Okay, for example, you have this is the repurchase price which is less than 1,000. It means this sort of arrangement is called is a lease arrangement, and you have to count is under for using IFRS 16. And the third case is if there is no obligation. This means that you are selling with the right to return. Clear? Okay. Now, in a nutshell, I will just sum it up, and then we will move to the actual reading. So here I have told you that if you have forward or call option, then what does it mean? That control never transferred. Okay, and if control is not transferred, then it means no revenue recognition. You will look at the purchase price. If it is higher, then it means that this is loan, and if it's lower, then it means this is lease. Clear? Another one is put option. And put option, you will look for the obligation to repurchase. If yes, you have obligation, then financing, that will be your higher price, or lease mean lower price. Clear? If no obligation, then it means sell with right to return. Clear? Now what I have just discussed here, let me recap it again, and then we move to the actual study. Clear? Here let me okay. Yeah, I think we have started here. Now you see here, I have told you that an entity sell an asset but retain the right to repurchase it in the future date. Then we call that as the sale and repurchase agreement. So entity selling an asset and retain the right to repurchase the asset at the future date, then we call that sale and repurchase agreement. Now the accounting treatment based on the nature of the option and transaction structure. For that, you have to determine that how to treat or how to account it for. Then you have to take that whether the seller has the right, seller has the obligation, seller has the right, and you will also consider the repurchase price in relation to the original sale price. Now, if the seller has the obligation to repurchase the asset, then we call that as the forward contract. In case of forward contract, the seller must mean forward repurchase the asset and no revenue should recognize because control is not transferred to the customer. In that case, you have two options how you will deal such a type of transaction. You will consider it as a loan or you may consider it as a lease. So if the repurchase price is greater or less than original selling price, then we call that is the loan agreement, and we will count as record the loan with a 20. This is the example which I have written here. 1200 is the original price, which is greater than 1000 original selling price. Repurchase price is greater than that of selling price. So we will count this as a loan agreement, and the extra amount will be your finance cost. Now, if the repurchase price is less than original price, then it means that this is a lease and you will deal it with under IFRS 16. Now, for call option, we mean that for call option we mean that seller has the right to repurchase the asset, and you should also count this. You should also follow the same criteria, the same accounting treatment as we do for the forward contract. Then, if you have put option, means that obligation to repurchase the asset at customer request. So means the customer can force the seller to repurchase the asset, and the accounting treatment for this depends on the repurchase price versus original prices. So if the repurchase prices, let's say, is greater than the original selling prices, then you will consider it as a financing, means loan. This is the example that 1100 is the repurchase price and 1000 is your original selling price, and you will record as a loan, and extra amount will be your finance cost. And if repurchase price is less than original selling price, then you have to deal it with IFRS 16, and that will be counted as IFRS 16, that is regarding lease. Now, if no obligation exists, then that will be your sale will right to return. So in simple term, you can say that in call in forward option, the control is never transferred to the customer, no revenue should be recognized, and you will check the purchase price. If the purchase price is higher, then you will consider it as a loan. If it is lower, then you will consider it a lease. If you have put option, then you will check that whether its obligation to repurchase exists. If yes, then it will be loan if the price is higher, and it will be lease if the price is lower. Now, if no obligation exists, then it means that sale was right to return. Clear? Now let's move on to the text here. Okay, let me zoom it. Okay, here. Okay, this is the sale and repurchase agreement under IFRS 15. Okay, so a sale and repurchase agreement involves entities selling an asset but retain the right to repurchase the asset at the future date. Clear? Now, these arrangements can different treatment, different on the nature of the repurchase option and the transaction structure. Okay. Now, the key factor to determine the accounting treatment is whether the seller has the obligation or whether the seller has the right to repurchase the asset. And you'll also consider the repurchase prices in relation to the original selling price. Now, if you have forward contract, which means that obligation to repurchase, so the entity has obligation to repurchase the asset at a specified price. This generally no sale accounted for accounting for because control is not transferred to the buyer. Now, how you will treat this? It will be treated as a loan if the repurchase price is equal or greater than the selling price, and it will be treated as lease if it is less than the original selling price. If you have call option, mean right to repurchase, then the seller has the right to repurchase the asset. Customer does not gain the control of the asset, and the seller retain the ability to repurchase the asset. Clear? And you have to follow the same rules, accounting rule, that you have followed for the contract, forward contract. So if the repurchase price is greater or equal to the original prices, then you have to treat it as a loan. If repurchase price is less than the original prices, then you consider it as a lease. We will deal at under IFRS 16. Now, if you have put option means that obligation to repurchase at a customer request, mean that the customer has the right to force the seller to repurchase the asset at a set price. So accounting treatment defend whether the financial is there is any financial incentive for the customer to exercise. As a financial incentive exists, then definitely you have to consider it as a loan. Now, how you know that financial incentive exists? So let's be simple. If there is no obligation to repurchase, then no financial incentive. The transaction record is sale with the right to return. Similar to the consignment arrangement, where the customer has the option to return the asset. We have also discussed this in the previous lecture. Now, if the purchase price is equal or greater, that means that this is financing arrangement, with this financial incentive, and you will consider it as a loan, and the seller does not recognize the revenue but instead record it as a loan. Now, the assets stay on the seller book because you have not transferred the control. It means that is not a real sale. Now, if the purchase price is less than, so that means that this is your lease, and you have the seller effectively retain the control of the asset and transaction still is a lease, and the customer is seen as paying the seller for the use of the asset for the period, and the seller regard the arrangement as a lease rather than sale. Now we have a conclusion here, and then we have some one example from test for understanding from the kit. In conclusion, that the accounting treatment of the sale and repurchase depend on the repurchase terms. So, if the control does not pass to the buyer, no revenue should be recognized, and the transaction is treated as a loan or lease. When you are treating it as a loan, when the price is greater than the selling price, the original selling price, then you will consider it as a loan. If repurchase price is less than the original price, then it will be your lease. Now here we have example here. Okay, now this question is saying that discuss that the rental should account for the sale of apartment block in the year 31st December 2001. This is your question. Now, how you will treat this question? First, you have to understand that whether this is a lease, this should be treated as a lease, or that should be treated as a loan. Depend on your assessment, then you will treat that accordingly. Clear? Okay, so L is a property developer, Lentil is a property developer. On 1st Jan 2003, 1st Jan 2003, Lentil sold apartment block that had a carrying value. This is the carrying value. Fine. And to Brain, this is the customer, or what you call it, for 4 million. The original selling price is 4 million. Clear? Now, including the sale contract, there is a clause. There is a clause, and the clause that means that Lentil has obligation to repurchase the asset. So this means that the Lentil has the obligation to repurchase the asset, and this means that this arrangement is sale and repurchase agreement. Clear? At the request. So this is the customer request for this one. Okay, and we have studied that how you will treat if you have scenario like this. You see here. Okay, put option. This is called put option. Mean to repurchase at a customer request. Clear? Good. Okay, now the request on 31st December 2004. Now the estimated market value at this date is 4.5. Now you see here, the question is very simple. And here we have market price as well as selling the repurchase price, which we call as, wait a minute, this is your market price 4.5 million, and this is your repurchase price. So what does it mean? It means that Lentil has an obligation to repurchase the apartment block at brand request, mean the customer request, at 5 million. Okay, and the original selling price was how much? This is the 4 million. Clear? The estimated market value of the asset on 31st December 2004 was 4.5 million. So the repurchase price 5 million is higher than both the original price was this one, original selling price, and the market value that is 4.5 million. So what do you understand from this? This means that it indicating that the brand would have a significant economic incentive to repurchase indicating the brand would have significant economic incentive to repurchase option. This is the put option. They have to exercise the option. Clear? Now, what you will do if your repurchase price is greater or equal than original selling price? The simple rule is that you have to recognize no revenue, because there is a probable chances that they will exercise the price, and you will consider this is a financial liability for you. And lender should recognize the financial liability for 4 million, the amount received from brand, and amortize this liability over the term of the repurchase agreement. And finance costs should be recognized in profit and loss based on the effective interest rate applied to the financial liability. Okay, so this is simply is a loan arrangement. Clear? And we have studied here, let me recall it back and it will be better for you to more understand. Okay, here I had told you the case is simple with lender. When you have option, obligation to repurchase at the request of the customer, and then Lentil has the obligation to repurchase at the request of the customer, that was brand. And then you will see that whether if the purchase price is equal or greater, then you will do it as a financing arrangement and you consider it as a loan. Okay, you will not recognize the sale revenue because this is not a sale, but it will be your loan, and this asset should be recorded in the Lentil, mean the seller account. The asset will be stay at the seller account, and that they will consider the amount they receive as a loan, and this will be a financial liability, and the amount was 4 million, and you have to treat this accordingly. Clear? The finance cost for that should be recognized in the profit or loss. I think this is more than enough. I think you have already understand that how to treat when you have a case like sale and repurchase agreement. Clear? Thank you for watching.